Hello, and welcome to this video series by California Restaurant Mutual Benefit Corp, also known as CRMBC. My name is Kea Stanley, and I am the CEO and chair of the board for CRMBC. And I'm joined today by Mike McDonough, who is our broker sales liaison for CRMBC, also the principal of McDonough Insurance and the author of the book, The Employer's Guide to Workers' Comp. Mike, welcome. Thank you for being here today.
Good morning, Kea. Thank you for having me today. I'm so grateful to be here and spend some time with you to talk about my favorite subject, which is workers' comp.
People think it's kind of boring, but it's one of the things that is the most misunderstood, the place where most employers are losing the most money in their businesses. Mike, tell us a little bit about you and your background and how you came to be working in self-insurance in particular and in workers' comp.
That's a great question, Kay, and thank you for the opportunity. I started in the insurance business about 40 years ago, and the last 25 I've spent primarily working with employers and focusing on how to really reduce their losses by managing work injuries. And by doing that, I found many resources and opportunities to help employers understand how to really mitigate their risk by managing their employees' injuries when they're, get injured on the job, and how to focus on keeping the culture and also not only the safety, but also working with the HR, which ultimately helps the employer control all their costs.
And there's a lot of different ways that people can insure that risk. There's traditional insurance, there's captives, there's high deductible plans, there's self-insurance, there's self-insured groups. Workers' comp, or CRMBC, is a self-insured group. So in this video today and in this series, we're going to break down all of the different parts of workers' comp self-insurance. And so today, the point of this group is to talk about just insurance. In later videos, we're going to talk about the nuances in all of these different aspects. So first today, can you talk us through first, what is traditional insurance, the one that everyone's most familiar with? Tell us about traditional insurance.
Well, traditional insurance is basically, it's called guaranteed cost or standard insurance. And so every employer that has a business has to cover their employees for work injuries and loss of income. So the normal procedure is the employer provides their payroll to their broker. The broker uploads that to their carrier. They're underwritten based upon how long they've been in business, the number of employees, the industry they're in, and so forth. So once a premium is calculated and the employer agrees on that premium, what then happens is all the control is through the traditional insurance carrier. So if there's a work injury, the employer reports it to the insurance carrier. Then that insurance carrier assigns it to a claims examiner who then is managing that claim. If there's any type of situation where it's a catastrophic injury, something that's complicated, and the injured worker or that family decides to hire an attorney as an example, the insurance carrier is going to be managing all that for them. And so what happens is there's really no control for that business owner. So if there are work injuries and there's catastrophic injuries or frequency of injuries, what happens is that employer can experience a substantial raise in premiums, which is kind of out of their control. So that's really what happens in traditional insurance is you pay based upon your payroll. If you're having losses, then you can expect your premiums to increase. And that's really a disadvantage to the employer.
So the other thing that I like to think of when I think of a traditional insurance, it's sort of like a casino. In a casino, the house always wins. So you might go to a casino and win here and there, but over time, the casino is designed through mathematical equations to always make a profit. Traditional insurance is basically the same thing, where they are for profit. They answer to their shareholders. So to really dumb it down, you pay in your contribution, and that money gets divided up like a pie. Some of it goes to their shareholders, some of it gets invested, some of it goes for overhead, some of it goes for their massive marketing budgets. Think of the high-rise office building in New York City, or the football stadium, or the Super Bowl halftime commercial. all of that money goes into all those different places, and some of it goes to your claims. But the goal of the insurance company is not the injured worker or the business owner. It is their profits. And so this is the reason why the largest companies, if you think of Disney or Walmart, this is why they self-insure, because self-insurance is one of the most financially lucrative business models that exist on this planet. So now talk to me a little bit about standalone self-insured. Let's just start there and talk about the concept of what is standalone self-insurance? How does it work?
That's a great question. And self-insurance, yeah, that right there, it just tells you the first word is self, so you're taking care of yourself by managing your costs. And so these large corporations that you mentioned, Walmart and Disney and, Costco or any of those, they've realized that going through traditional guaranteed carriers, that it costs them a lot more money. And so I would say a good starting point to self-insure is like if you're paying at least $1 million in premiums, that's a good start because it does require a little bit of cash flow, and you have to set up a letter of credit. And so when you start having claims, that letter of credit needs to be increased. So your collateral needs to be increased as you're having claims. Just like an insurance company, they reserve for claims and things like that as well. But with a self-insured employer, they truly have all of the control. They're making all the decisions. They are overseeing all their claims. They are selecting who their defense attorneys are. They have their medical clinics that they go to. So from every aspect, from an injured employee, that self-insured employer is making all the decisions, and there's no outside influence from an insurance carrier or other third-party vendors. So that self-insured employer is actually saving real money because they're watching the cost of every claim versus just paying $1 million to an insurance company and letting them spend at will.
And they're not paying for the profits of a for-profit insurance company. If there's extra money, it goes back to their bottom line as opposed to going for the profits for a large company. But there's a way for smaller companies and mid-sized companies to get those same benefits, and we call that a self-insured group. So CRMBC is a self-insured group organized in California that's governed by the Office of Self-Insured Plans and the Department of Insurance. So talk a little bit now about what is a self-insured group, how is it organized, how does it work?
As a self-insured group it's really an opportunity for smaller employers, like you mentioned, that don't have the resources or the cash flow to put up a security deposit. They don't have the money to put up the collateral. So when they join a SIG, a self-insured group like the CRMBC, they're able to join like-minded other individuals. So the CRMBC, which is restaurant owners, it was a program founded by restaurant owners for restaurant owners. So in reality, what they're doing is they're all pooling their money, just like an insurance company. Everybody's paying their premiums, but instead of paying the carriers, they're putting their money together. And then collectively, what they're doing is with their loss control and safety, is they're really managing their risk and they're reducing the cost. So once the expenses are paid, their administrative costs, their claims cost, any expenses that are paid, that's all paid out. Anything that's left over, because it's a nonprofit, that's what we call surplus, that's owned by the membership. So that's where the sharing comes in, and everybody in the group, the members, they're not paying or they're not beholden to any outside influences like shareholders and so forth. They're all joint sharing in the profits and losses together in a SIG. But the big difference is that they don't have to put up any collateral or security deposits. They can just come in first dollar one, and we're going to take a look at their loss ratios, their payroll, and this and that. And then once we understand that they're a good member in good standing, then we can offer them a very competitive rate compared to the standard market. And then that member comes in, and out of all these years I've been working with self-insured groups the last 18 years, I've never had a client say that they wanted to go back to the traditional market.
So to summarize the self-insured group, first of all, it's a group of business owners from the same industry that come together to form a self-insured group. The self-insured group does put up collateral and is licensed and regulated by the state. They have a board of directors that's made up, so CRMBC specifically, the board of directors is made up of restaurant owners. And then there's an administrator who administers the group. There's a third-party administrator that handles the claims. And we've got a legal panel that, when things are litigated, handles it. But the benefits are basically twofold. One is financial and one is control. From a financial standpoint, over the last 110 years, self-insurance has outperformed traditional insurance on every single measure. Because over time, like we said, over time, the traditional insurance is like a casino. It's going to win over time. It's going to profit over time. Self-insurance over time is going to be better for the insured. And then the second part is control. You mentioned that in traditional insurance, you could have a claim that becomes litigated and settled out for something that you have no say over, and you don't find out about it until your rate goes up in a couple of years. In a self-insured group, our members get to touch that claim from beginning to end. They work with our adjusters. They work with the legal team. They can go to the depositions. They have say in how the claim is handled. That is everything when it comes down to managing the cost of your workers' comp spend using a self-insured group. So we're out of time on this one, Mike. We'll talk to you next on the next video, where we're going to talk about the next topic. Thank you for being here, and we'll see you on the next video.
Thank you so much, Kate. Have a great day.